What's going on, guys? It's Tyler. Wanted to run through the USDA loan approval process. Basically, we've talked about the USDA loan before, credit and things like that. So USDA loans specifically. Before we go over that, remember to like, subscribe to the channel. We make videos, regarding the loan process, credit, investments, things like that. Also, leave a comment down below. What type of loan program did you end up going through when you purchased your first home, or do you have questions about the USDA loan in general? Anything I didn't go over, something you would like to hear about in the future? Let me know down below. So the USDA loan, specifically today, we're going to talk about the USDA guaranteed, the 502 guaranteed RD loan. So this is the cut and dry, plain vanilla, no down payment government, RD loan. So there's only really two no down payment government loans, a VA and the USDA. And the USDA does have a few different direct and some subsidized programs and things like that. But the guaranteed is the normal one, the one that everyone really would be applying for, the general public. So USDA underwriting in the last few years has gotten a little bit more strict. It used to be pretty easy to get them done with a little bit lower credit score. They weren't as picky about some of the stuff on your credit. If you were 620 or above, 640 or above, it was pretty cut and dry, pretty easy to get done. Recently, over the last probably year and a half, the automated underwriting system named GUS, the Guaranteed Underwriting System, has gotten a little bit more strict on some things, and we've been seeing more readouts that make it a little bit more difficult to get the loan done. So a couple things up front. What sort of things can disqualify you from the USDA guaranteed loan? Because it isn't available to everyone. Specifically, the program is for moderate income households in rural areas in move-in ready condition houses. So let's break that down. Moderate income households. How do you figure out if you or your household will qualify? So first thing is household is what we're saying. So you, your spouse, grandma living in the basement, your 26-year-old son out of college living in the attic, anyone in the house is being accounted for with the USDA loan. So you have to be under the income limits for the household, not just who's on the loan. So you can go to the USDA site under guaranteed loan, income restrictions, income requirements, and you can find it goes by county and then how many people are in the house, and there's different little calculations that go along with it, but you can calculate it for yourself what your area is going to require. So, but typically, somewhere between 80 and 100,000 for the household. If you're quite a bit over that, if you yourself, just the borrower, make 120, and then a couple people make 20 grand here and there, or you can pretty much figure out if you're way over, it's probably not the best program for you. If you're close, I would still bring it up to a loan officer or have them run the numbers on it, because there's little things here and there, deductions, childcare expenses, stuff like that you can account for to kind of whittle down that number a little bit to get you where you need to be. So that's kind of the first thing cut off as far as income restrictions for the USDA loan. The other is area. It's a rural development loan. So the house that you're buying has to be in a rural area. How is that determined? It's based on population density. The site isn't definitely the most up-to-date thing. Some people I talked to are like, this is literally in the middle of the woods. Why is this area ineligible? Or this is really right outside of town. I mean, like, we're in a suburban neighborhood. Like, why is this eligible? So it's one of those things. But, it is the end-all be-all of the restrictions is the map on the USDA website. That's what the government underwriter is going to go off. That's what your loan officer is going to go off. That's what you have to use to determine the area eligibility. So again, that's right down on the USDA site below. You can Google just USDA income limits or USDA eligibility map. It'll bring you right there, but I'll link down below. It's right on the USDA.gov website you can check out. And the last one is move-in ready condition house. So this is pretty typical for any of the government loans, USDA, FHA, VA. The house needs to be in move-in ready condition. What does that mean? It's based on the guidelines of the loan, but typically looking out for the big ticket items. You know, roof looks like it's been leaking or it's right at the end of its life. You know, furnace isn't working. There's, you know, holes in the ceiling and the floor. Looks like there's some water damage. Utilities don't work. You know, big things like that. But there's also some picky things as well. You know, there's on the back porch, you know, you got a wobbly railing, or it's not the right height and it's, you know, not safe up to code. Or there's some peeling paint on the back of the house. You know, it needs to be scraped and repainted. And with USDA specifically, they don't allow any multifamily properties. So if they can be extremely strict on this. You know, you got a garage and there's kind of an in-law apartment up there, or you have, you know, a walkout basement that has maybe its own toilet down there and, you know, the possibility to make it a separate unit. It depends on the appraiser and how they're going to be, you know, how picky they're going to be, but it can definitely inhibit the loan if there's something like that. If there's an accessory dwelling unit, you know, maybe a little guest house, anything like that isn't going to qualify. So something to kind of keep an eye on. But generally, you're looking for the big ticket stuff again. You know, something that you would walk in, immediately know that I need to fix this for me to be able to live here. Again, the roof's leaking. You know, the furnace doesn't work. The electricity doesn't work. You know, the heat's messed up. Something like that where the house really isn't, you know, livable. So those are definitely things to be looking out for as far as move-in ready condition on the house. So say all that stuff, you're in the income limits, your area is going to qualify, the areas you're looking in, and you get the idea of the move-in ready condition home. That's fine. You know, your realtor has been doing this a while and knows what they're looking for. Perfect. So you applying for the loan yourself. So we've gone over credit and stuff in prior videos. Basically, the better your credit score is, the better, you know, the less debt you have, the better position you are to be able to get a loan done in general. USDA, FHA, conventional, doesn't matter. So with USDA specifically, there are, you know, minimums as far as what you can be qualified with. 580 technically is the minimum for a USDA loan. I don't think I've ever run into anyone doing them under 620. So 620 is the minimum that we do. Again, I don't know if anyone really does them under that, but technically you can. So 620 to 640 is going to be an automated underwriting system. It's going to be an automatic refer. So they're going to be more strict. It's going to be a manually underwritten loan. And it's going to be tough. But like I was saying before, is the guidelines have gotten a little bit more strict, and we've been getting a 10.8 refer. And what that means is there's another kind of subset of guidelines in the USDA guidelines that specifically refer to basically extra strict manually underwriting terms. You know, you're going to need extenuating circumstances for really any negative account on the credit, late payment 5 years ago, a medical bill. Again, things that we normally don't even think about. Credit scores there, you're good. USDA 10.8 can kill loans. So again, I've had ones where, you know, there wasn't a good letter of explanation on why you had a utility bill from 3 or 4 years ago that you paid off, but they can see that you had a collection from 3 or 4 years ago that was paid. And they didn't have a good mitigating circumstance or showing that it was a temporary situation, and they denied the loan, or they used that as, there was other factors too, but you know, they hinged on that to deny the loan. So that's definitely something to account for. You really want to be over 640 with these USDA loans. Again, we do them all the time, you know, under that 640 mark, but it's just a pain. There's a lot of stuff. They're going to verify rent. They're going to be picky about every little thing on your credit. And again, it just would benefit you to be over a 640. That's the minimum you need to be able to get and accept through the automated system with USDA. So you've applied, you've gone through the automated underwriting system, whether you got a refer or an accept or whatever. There's going to be a lot more documentation required for final loan approval. Typically, you're going to want a month's worth of your pay stubs, 2 years of, you know, W-2s or tax returns or 1099s, 2 months bank statements, you know, additional assets, your 401k statement, IRA, stuff like that to verify. If you've been renting, they want a verification of rent. If you haven't been renting and you're living with your parents, you're living with your girlfriend, rent-free, they'll want a rent-free letter. They need to verify your rent typically one way or another, but verifying you don't pay rent is verifying rent. But verifying you pay $1,000 a month and you're getting a $900 a month mortgage, obviously it looks good. So all kind of plays into it. So usually they're going to want 2 years of your employment history, 2 years of your rental or address history, and that's for other reasons as well, verifying your taxes and stuff. But they're going to want 2 years history for you. The caveat, specifically with USDA, is they're also going to want that for your spouse. They're going to want that for your mom that lives in the house with you. They're going to want that for your 25-year-old, 26-year-old kid that's out of college, that's living with you, but has a job. Like we talked about, there's income limits for the loan, and it's going off the entire household. So we need to get their tax transcripts. We need to get their history. We need to get their W-2s. You need to get their pay stubs. You need to get their assets. That's what makes the USDA loans a little tougher, is they just want all this documentation. And this is really where most of these loans die. Not that the loan isn't approvable. It's that mom doesn't want to give you a bank statement. We can't find the W-2 statement from 2 years ago for your wife, and you don't want to, call your old employer because you don't get along with them to get it. Or people just get frustrated. Why are you asking for more documentation? I sent this. Well, it wasn't correct. This just frustration builds up throughout the process, and that's why these take a little longer. That's why they're a lot more in depth. And a lot of people just end up walking away, unfortunately. So again, not to scare you away from these loans. They're great, and they're not as hard as it sounds, especially if you don't have 20 things going on. You don't have a bunch of people in the house. You don't have a weird, job history. You haven't had 5 jobs in the last 2 years. You have a good rental history. You have a few bucks in the bank. The loan process can be just as easy as anything else. But typically the people applying for these no down payment loans maybe have a little bit more complicated situation. Don't have that much money. Don't have that great of credit. Don't have that great of job history. Have a few other people they've been living in. Haven't been living in the same address for a long time, or I was living here with my girlfriend and then we broke up, and then I was living with my mom for 6 months, and then it can get complicated, and that's when these kind of run into issues. But really the upsides of this program are great compared to a lot of the other government loans. No down payment, extremely low mortgage insurance compared to like an FHA or conventional loan. Comparable loan amounts, again, like half of the mortgage insurance compared to like an FHA loan, or less than half. And you can also roll in a lot of closing costs, which is huge. So typically we try to get the seller to pay them. We try to negotiate in that, so there's no way that the borrower is going to have to bring anything to closing. They've got no down payment, and the seller's paying all their closing costs, and they're square, and they don't have to worry about it. But just say the seller only contributes a little bit or doesn't contribute at all, the house is worth more than you're buying it for, you can roll in closing costs. We can do a loan amount up to what the house is worth. So you're buying it for 100, house is worth 105, and you can get a loan you're qualified up to 120 or whatever. You can do a loan up to 105, what the house appraises for, roll in your $5,000 in closing costs, and you're square. So that's one of the best things about this USDA loan, is that we do have that ability to up the loan amount, include all the little things here and there, and even get you money back at closing. We can get you the money back you paid for your inspections, get the money back you paid for your appraisal, get your earnest money deposit back, have negative amount due at closing, essentially. So there's a lot of positives that go along with the loan, as well as a lot of things that make it difficult to do. But that's essentially what you get with a government loan. They're not giving free money away. If you put in the work, you put in the effort, you can get into one of these loans, and it's an awesome program. I mean, really, if you're not qualified for a VA loan and you don't have a lot of money, this really is the best loan you can get into. Again, I would always recommend, if you have the ability to go with the USDA loan, do it. Just because, again, you're going to be in a better situation. If you're doing an FHA loan, apples to apples, your payment will probably be the same, and you won't have a down payment, is essentially what it breaks down to. So, again, take that what it is. If you have any further questions about the USDA loan, I know it's complicated. I know I run through these things pretty quickly. Leave a comment below if there's any specifics you want to go over. If you want me to do another video regarding the USDA loan and more in depth on a certain part of it, just let me know. Remember to like and subscribe. Again, I love doing these videos. These are the same conversations I have every day with people, and I love getting it out there and trying to help people get them more prepared. with looking into these government loans. Hope it helps, and hope to talk to you guys soon. You all have a great day.